Okay.
So they didn't exist in the 1980s. So you didn't have an access tool for most people. So when you had the buying in the 80s and it was institutional, it was speculation, it was this huge run up. But most wealth managers are back then there wasn't a democratization of assets, so that people didn't have mutual funds ever really, right? So you had high net worth investors who had stock accounts, and everybody else couldn't partake. I think what you have here is broader access, right? People in India, China, anyone can get exposure to gold through an ETF, through a closed fund, or through a firm like ours. And so I think it might add to that bubble, or it might round it out. I think it'll help round it out because you have a broader a diversification of buyers now.
Okay. So enough of the devil's advocate questions. I would ask you to give me the bullish gold sale, but it seems like you've pretty much done that already.
Sure.
I'll give the floor open to you, though. Anything you want to add?
And you can go after me, Brian, but it's so if you look at our company, talking more about our company.
Well, actually, before you go on, there is one thing. Give me the bearish argument for gold.
So I think the simple bearish argument is things work itself out. The euro stays intact. Tax revenues increase. We fix austerity measures actually work. People start paying off their debts, and there's assumed confidence around the world.
In other words, there is no bearish argument for gold, is what I'm hearing.
It's hard,
because
right?
that's not happening. So
it's very hard, right? But I wouldn't be in this business otherwise, right? So I'm the absolute wrong person to ask.
Okay.
But on your previous question about is there anything else, I would say if you look at our management of our team, none of us actually came from the gold industry. So literally none of us. And so, and this I'm getting off the gold topic, but more about the business. The reason why we're all here is because we saw a niche asset that was coming to fold, but one that was completely opaque. That was people were getting ripped off left and right.
Right.
And we came in to want to fix that. So just like mutual funds democratize stock ownership to the masses, we want to do that in the gold market. So a few years ago, if you wanted to buy physical gold, you're literally calling like coin dealers, people online. It's not a nice, convenient process. But if you have $50 million in the bank, you can call your private banker and they'll open up a nice account for you in Zurich, and they'll put gold bars there that you can go check out and have shipped to you. But you had to have $50 million to do that. You had a $50 million account to do that. And so the idea was to make that available to everybody. And so I think we're still at the very early phases of where that's going to change, where people still have the idea that that's actually my bar, that's your ownership. And I always use the analogy: if I could buy my house directly, or buy my house through owning shares of a trust that owns a piece of that owns my house, I'd always buy my house directly. And if you can have that ability to own real assets, you should always do that, because in the end, that's what rich people have done forever. And if we can make everybody else do that, they should do that, because it's a safer way to do things.
For the small investor or the medium investor, you feel you have a more efficient purchasing mechanism than going to a coin dealer or
Absolutely.
a bar dealer?
It's so,
in terms of pricing. In terms of pricing.
Pricing, but
and transparency.
Transparency, authenticity. If you store it with us, it's guaranteed liquidity because we keep it within the LBMA chain of custody. So you buy it from a coin dealer, take it home, but when you want to go sell it, where do you go sell it? What price do you get? You don't have any of that opaqueness, any of that sort of flexibility that you have. I think people will always pay for optionality. I'll always own gold, and I'll keep it in a vault in a location outside my house to remove the risk of my house. But it gives me the option: if I want delivery, I can get delivery. If I want to ship to another country, I can ship to another country. But it gives me that optionality that I traditionally don't have.
I see. And so you have options of storing in separate other countries. The advantage and disadvantage to storing, say, in Switzerland, which I think the advantage is probably significantly reduced now with the heightened aggression of the U.S. against the Swiss secrecy laws, right?
We don't publish an advantage or disadvantage as client preference. I think
this is more of an informal question, so I'm not trying to get you in trouble.
It's a client preference. I think there's something nice about having geographic diversity too.
Right.
If you're going to diversify and it doesn't cost you anymore, we don't charge anymore for it. Might as well do it.
Okay, so there's no surcharge in storing in other countries at all, and no difference in storage.
Nope.
Fees, I'm saying.
No. So one of the things people.
Well, that's a big plus. That's something you should speak up.
We could have made a lot more money if we did what everybody else does, and we weren't just an agency basis, right? We had a desk. You could make you could make significantly more money. But our idea is we didn't do that because we said, if we do this the right way and we build it out over a long time, you actually create a business. You don't just create like a short-term run-up and make a lot of money, you're gone. You actually create a lasting business, and so that's what we're trying to change. Okay. Which is not a mentality that you really see in the gold business, as I'm sure you've seen. There's a lot of charlatans in the business that are making lots of money that we hopefully will remove.
Okay. You said you had a trading desk or traders. You have actual traders.
Sure.
How big is that operation?
It's 3 people. It's 3 people. So a trading desk was a bit of a misnomer for us. So it's so a transaction comes in. So you're a wealth management firm or you use our trading software. An order comes, it hits our system. It's bid out to the market of dealers, and whatever dealer comes back with the best price, this is electronic, you can say, okay, that dealer gets the price. The final confirmation is still over the phone, so our trader still calls and says, confirming this order, done, on a recorded line. And we do that for two reasons. One, this is still completely an over-the-counter market, so you can't trade electronically, and there's no clearing firm in the middle. And two, so we have a recorded line conversation that the transaction is actually completed.
Okay. And if the other side reneges?
We go to the second best price and the third best price. So we actively farming out what the best market price is at that time.
Okay. So walk me through as a neophyte through the transaction. I place an order. I'm a large buyer, $25 million.
Yeah.
Okay. You call, you get a price at X.
Yep.
Okay. You confirm price X with the buyer?
It can work that way, but think of it as a market order. So you place a market order and you come back with the best market price that you can get.
Okay.
But you have the ability to put a limit order. So you can say, I don't want to pay $1 above 17.62. You can say, okay, we'll do a limit order for you.
Okay.
So it's just like buying a stock. So if you go to E-Trade, you don't know what price you're actually going to get until the transaction execution comes back.
Right.
It's the same thing here. You have a very, very good idea what it's going to be within a few pennies, and you have the same here. But if you don't want that little bit of if there's a little bit of volatility that you're scared of, then you just put in a limit order. You can tell us that you want to put a limit on it.
So when the price comes back, it comes back verbally over the phone, though?
Electronically onto your workstation, or it depends what you want. We adapt to what the client wants.
Okay. But until there's physical delivery, there's always opportunity for the counterparty risk. Or
correct. So we don't take funds until the bar we actually get possession of the bars.
Okay. Okay.
So the client's not really out.
Okay. I understand.
Now, so we actually take a little bit of risk, to be honest, because if the client doesn't pay us, then we have to cover we have those gold bars, we need to sell back to the market if there was price loss, and we'd have to suffer that.
Okay, and you don't hold client funds?
So it depends on the client. So there's risk. So the larger institutions that we work with, that we service, we have guaranteed settlement where they guarantee to settle every transaction. For individuals, we ask for funds up front, which are stored in, again, a well-capitalized bank that are segregated funds. All the protections that I think everybody else probably uses now. Okay.
So guaranteed settlement when you deal with the larger banks, and I'm very bearish on banks. I don't know if you've read my work, but I don't want to get into it. It's not my interview.
Yep.
But I can see where you could open yourself up to a significant risk with guaranteed settlement. Let's say from Bank of America.
Sure.
It's my opinion, Bank of America might not be around for the next few months. So, how do you hedge against that, or do you?
We can't really hedge against it, to be honest. So if we're serving a big bank, we take that risk. So it's a risk that's out there, but that's the risk you have to take if you want that to be your client.
Okay, understandable. Okay, and for those who say gold is in a bubble, what do you say?
I don't know, Brian.
No, I think it goes back to the under ownership. I mean, a lot of people talk about this. You see it on the news everywhere, but not many people own it, especially in the institutional space. I think overall financial assets is still less than 1% in terms of overall ownership. So until this is really widely adopted, and you're seeing it better adopted at least in other areas of the world, but not especially in the U.S., and you're seeing continued buying coming in from central banks, that could start a trend with other types of investors,
and reconcile that.
It's finite. Yeah, it's a finite asset.
And reconciling that against its meteoric rise over the last few years, still.
I think a price rise is different than ownership. So.
I'm sorry. Say that again.
A price rise is different than ownership. So, tech stocks, will keep using that, or every institutional fund owns some CDOs or tech stocks, and with gold, it's just still under owned. The price may have gone up, but the ownership has not really increased that much.
Even inflation adjusted based off of old highs, I mean, that's somewhere in the $2,300 to $2,400 range, and we're still not even up into that territory yet.
Okay.
And I'd argue things are a lot worse now than they were.
Okay.
I know you feel that way too.
Okay. Well, very good. Thank you for answering the tough questions.
Sure.
Of course, I have to play devil's advocate,
sure.
but
Sure.
it definitely lends credibility. You did a good job.
Thanks.
Anything else you want to add?
I think that's it. Yeah.
Right. Well, there's an obvious question. How did you come across me?
I mean, we're in the space, right? So.
Okay.
There are lots of buyers of our product that read, blogs and things like yours. So.
Okay.
It's a bit of our job too to keep a pulse on what people are reading and thinking.
Okay. Well, good luck, gentlemen. Thank you.
Thank you.
Great. Thanks.